see you. Alphabet is a company that's done all the things right. We have talked many times over the years, you and I, and it was underrated for a very long time. And I think it's now being fully appreciated for what it's doing. But coming into earnings, we expect to see Google Cloud continue to deliver. It's going to be 35% growth once again. And this company continues to build its entire infrastructure largely on its own cash flow. And that's what I really like, is people are sort of throwing tantrums. This is a company that really can't be thrown out with the bathwater. There was a lot of concern, is the advertising model going to break? Is OpenAI going to harm its business long term? And I think it's answered all of those questions with Gemini. It's answered those questions by continuing to see its Google search numbers strong, YouTube numbers strong, and it's delivering the cash that it can make these Capex investments. So while today has been an absolute wreck, it's very hard to watch what's happening. Google looks very good.
It's interesting because the story with Google is either it's going away or it's a monopoly. When ChatGPT came on the scene, it was, there goes its business model. I mean, a real existential risk. To their credit, DeepMind, everything, they come up with Gemini, and now they seem hard to topple. So the Google trade has done much better than the Nvidia OpenAI trade over the past couple of months. But do you think that continues?
Google's really stable. And what I like about it right now is, again, all these companies that are making large investments, because we know Capex is going to be in focus today. Can they continue to fund Capex? The reason people got nervous about Oracle was, how is it going to pay? It needs to raise equity and it needs to raise debt. But it actually was able to do so successfully. And that goes to show how insatiable the demand is. But to some extent, all the selling right now is pretty indiscriminate. And I see rotation going into people buying Walmart and Starbucks. But AI, if we're out there, this is a huge disconnect between what's happening in business, in enterprise. They are all building on these AI companies, and Google, Meta, Amazon, these are core technologies. So while some of the software, that software wreck, I keep saying AI will eat some software. Google, Amazon, Microsoft, these companies are absolute staples. And the people that don't think Nvidia is a value at, just over 20 times forward right now, I don't know what they're thinking. But to some extent,
I would ask then, could you be long both and feel and sleep at night? In other words, can you be long Google saying Gemini is going to win, and can you be long Nvidia saying, whoever they're powering, OpenAI or whomever else, is also going to win all at the same time?
Yeah, absolutely. Look, I was with a number of the AI leaders yesterday at the Cisco AI Summit. I was talking to Lip-Bu Tan, and we were talking about how memory, for instance, there's not going to be any relief there for 3 years, at least 2028, 2029. And the reason that is because this build out is going to continue. So Google, Amazon, we heard from Matt Garman yesterday, they're going to continue to build with Nvidia. And of course, they're trying to build their own infrastructure. Google's doing the same thing. Microsoft's doing the same thing. A lot of people want to do this zero sum thing, Kelly, they're going to build their own chips and they're going to stop using Nvidia. But what's really happening is they're going to build their own chips. They're going to use Nvidia. They're also going to use AMD. And they're going to need all this capacity. So the selling off of anything that delivers energy, memory, compute, it's a little bit crazy. I'm not saying it's wrong and that some of these multiples didn't need to be corrected and that there's not right for a sell-off. But I'm saying AI, the trend, that's like the internet, your last guest said, this trend is not going away, even if prices do come down further.
So you're sticking with the AI suppliers, let's put it that way, the ones who are building out the ecosystem. Quick final question then. Yeah. What about software? Do you just say, we'll see?
Well, my answer is AI will eat some software. And this is where you need to be able to pick out the companies that are going to win versus the companies that can be replaced. I saw Dee Bosa building Monday.com using AI Claude herself. That's a real problem for some companies. But, I look at ServiceNow's, I look at Oracle's. These are core business, and I call them the rules and the rails. Until AI can do both, build the software, but also manage that every day, updating the rules and the rails of running these businesses, it's not going to disrupt it. I see these two things working together. I see Anthropic and ServiceNow partnerships. I see OpenAI, Salesforce partnerships. I think ultimately they need access to the data that these leaders have. But the re-rating is real, Kelly. So the forward multiples will probably never be what they were at their peak.
What are you focused on, at least in terms of the quarter? This was, of course, the quarter where Gemini really broke out relative to some of its AI competitors. How much do you think that matters in today's print?
I think it matters a lot, Leslie, and I think we expect to see a couple of things on the Gemini front. First of all, we rewind back into Q4, we heard Google say they had over 600 million monthly active users on Gemini. I would love to see a number closer to 1 billion if they put out a number today. I think that would put them right on par with OpenAI in terms of some of the user metrics. And so I think investors will definitely pay attention to anything they say there in terms of usage. The other big part of Gemini, obviously, is converting that into cloud services usage and with enterprises. I think that's going to be the other big number here. I think the street and investors are probably looking for something in the low mid 30% growth range. And I think if Google can deliver that, the stock probably works.
Wow, no, that's a great point as it pertains to cloud as well as Gemini. Jason, we were just talking with Mac about Capex and the market's appetite. What do you think is the kind of the pain threshold for Capex in the quarter? How much, would really spook the market here, and how much are you expecting?
I think Alphabet is still a positive margin story. And so I think, they can spend more as long as the revenue is going up. I think when you compare that to Meta, basically what investors are struggling there is, basically the Capex is eating up all of the free cash flow. And then you basically have basically no improvement in operating leverage. Whereas here, Alphabet, first of all, their Capex is fungible between search and between the cloud business. And so they just are showing a level of efficiency around Capex spend and overall OpEx spend that other companies aren't. And to this point, so far, at least it seems that they have not been particularly capacity constrained compared to other companies.
Yeah, that will be something to watch for. And of course, they were the best performer of the Mag 7 last year. It's truly a consensus long. How high do you think expectations are, Jason, going into the print? It was down a bit today, along with the broader Mag 7 complex for the most part. Do you read anything into that? Would you say that's a buying opportunity potentially?
Yeah, look, you're obviously seeing a broad sell-off in tech right now. But look, we think, we're looking for search up 14 as our published number. My guess is investors are probably looking for a little bit better than that at 15. We're at 16% for the first quarter, so an acceleration. I think investors also want to hear more data points around ads in AI. So basically, there's been a discussion of when do ads come into AI mode? When do ads come into AI overviews? They cited AI overviews as a driver of a 300 basis point acceleration in paid clicks in the last quarter. So can that further improve? So really, it's whatever linear data points you can get to say more people are using AI through Alphabet products, and the ad opportunity is yet to come.
And Doug, how are you thinking about ads as a shareholder? I just look at kind of two examples today. The New York Times reporting earnings. It wasn't necessarily an ad story per se, but those shares currently down 7%. Washington Post laying off a third of their workforce. How do you kind of look at the AI or at the advertising ecosystem as it pertains to kind of legacy media versus the opportunity for some of these AI players?
Ads are still the golden goose for Alphabet, obviously. It is the vast majority of their business. It's highly profitable for them. And so to Jason's point, I think they'll have a nice, healthy number here in Q1. As we think about the story longer term, though, Leslie, we think a little bit more about what are they going to do in terms of personal AI? How are they going to monetize AI? Because I do think ads will always continue to be part of Google's ecosystem. I think ads will be part of these AI services we use. OpenAI obviously is dabbling in ads right now. Anthropic's making fun of them for doing that, if anybody's following that. But I think that over time, the subscription nature of AI and what these services can do for customers, that to me is maybe the bigger story as we think about how Google's business could evolve over the next several years.
Monster quarter for Alphabet here, but we are still seeing the stock wobbling today. Yes, the broader market is down, but Alphabet down more. What are your takeaways here?
Yeah, I'd say there's two reasons why the stock is probably down. One is, the massive Capex number that everyone's talking about. Talking about 180 billion or so in terms of the calendar 26, nearly double the level that we just saw in 25. And more importantly, what it does do is it does put downward pressure in terms of our free cash flow assumptions here in 2026 and also in future years as we're going to assume higher Capex spends. Now, Capex spend. Now, I'd also say the valuation side of thing also a little bit kind of, on the higher side of things, when you look at the other Mag 7 names, which, many have gotten punished a lot more so, and kind of Alphabet holding up much better. So that premium maybe comes down a little bit. But that said, you look at the results, to your point, the numbers were phenomenal. It really was all about cloud growing 48% top line. That backlog growth here, not only this quarter, but over the last 2 quarters, has been absolutely phenomenal. Provides some really great visibility over the next 2 to 3 years. And then when you even look at their other businesses, specifically search, they're finding new ways to really monetize that platform with AI, and that's really kind of led to an upward revision in terms of the growth trajectory there as well.
And Robert, I'd love to get your thoughts here too as well. Is this another case of what we've seen already this earnings season with great numbers and harder questions? Although there could be an argument made that on the call, Google really did answer a lot of the questions here about where directly that spend is going to. What were some of your thoughts?
Marley, this is a really important quarter because for 2 years now, the public market has rewarded companies for increasing their Capex into AI infrastructure. And Google came out with a mind-boggling 40% of revenue target for their 2026 Capex. That $180 billion, that's almost 90% of the operating cash flow they're going to generate this year. They gave Wall Street more than they asked for. And for the first time, Wall Street is now saying that might be too much. And part of what drove Google's stock up here over the past 5 months has been the success of Gemini 3, and the usage is incredible. But the revenue attached to that is so slow, and it's going to be a long time coming. And so now what public market investors are looking at is across the LLM space, there's about $50 billion of run rate revenue between ChatGPT and Claude and Gemini. But now they're seeing $600 billion of CapEx go out the door. That's a really big gap to close here. So I think those are the numbers now that investors are really starting to.
What is the difference between a company that announces huge spending plans and the stock rises and one that announces huge spending plans and the stock falls?
Yeah, Julia, the gap there is expectations. And so, like you referenced, at the midpoint of their CapEx guide, 180 billion, double last year. We had been forecasting 125 billion. Sell-side consensus was 115 billion. And I felt like just in our investor conversations leading into earnings, investors were around 130 billion. And so it's actually, it's a pretty big gap. And so I think investors today are digesting this guide on CapEx, but also with it, and what you just led with, this cloud revenue acceleration was massive. So you are seeing the AI demand and investments in cloud search growth accelerated. And Sundar also mentioned that there are capacity constraints still, just given the strong demand at cloud, at search, et cetera, for the strong AI demand. And so they're going to double CapEx, and they also said, like, even despite doubling CapEx this year, they're still going to be constrained entering next year. So that just gives you an idea of just how much demand there is for their AI offerings.
So it sounds like you think that maybe the sell-off is a bit of an opportunity for investors to step in, or that it's sort of misguided.
For sure. It's looking down 4 to 5% today. And let's, to be fair, the shares are up 60% over the past year. Sure. So, for us, if you look at Alphabet, they have arguably now the leading foundation suite models with their Gemini suite of models, which is driving, kind of like I just referenced, the cloud growth and all the opportunities there. And then, like, if you look at search, right, their core business, search growth accelerated by a couple points, beat street estimates. It was broad-based across verticals, across geos, and they said that AI mode and AI overviews drove record engagement at search, which is pretty historic. And if you go back over the last year, Alphabet's done an incredible job, A, with its Gemini suite of models, B, incorporating AI tools like AI mode and AI overviews into the kind of broader search umbrella, and really kind of stave off that that sentiment that was out there the last couple of years of ChatGPT being a big secular risk to Google search. And so, from that perspective, we're entering the year for Google. Their businesses, search and cloud, are in really good shape. They're accelerating. So, it may take a step back today, but I think the story is over the next couple of years, still.
Big tech now pouring more capital than ever into AI. Alphabet, Microsoft, Meta, Amazon expected to spend a combined $600 billion in Capex. That's this year alone. Our Deirdre Bosa has more on that in today's Tech Check. Morning, Dee.
Hey, good morning, Carl. So it is just simply difficult to get across how big a step up that number is. But this chart does get at it. Capex between these four companies was at less than $150 billion in 2023. So that is a more than fourfold increase in roughly 3 years. What it tells us is that big tech are becoming the new utilities, and that ultimately changes how you value them. Every company that wants to use AI, whether that's a bank running fraud detection or a hospital reading scans, they will need to rent compute from big tech. And so Microsoft, Meta, Amazon, Google, they're essentially building a new intelligence grid that is not unlike electricity. Once you're on it, you're tied to it. And for big tech, once they're an asset-heavy utility, their economics, they start to shift. Multiples compress. Capex crowds out buybacks. The metric shifts from revenue growth to return on invested capital. So rather than how fast are you growing, it's was that $100 billion actually worth it? Now, these companies, they have far better margins than traditional utilities, and that may cushion the blow. But the direction of travel is clear. And when you own the infrastructure that everyone depends on, regulators, they get even more invested. Now, the cloud build-out followed similar logic. Yes, investors, they actually got multiple expansion on the other side of that. But back then, customers were already paying. This time, these big tech companies are spending ahead of demand, betting on AI use cases that don't fully exist just yet. And that is a different risk profile, and the biggest reason the market may have to start valuing them differently.
I guess the question is, does that mean that they're undervalued or overvalued?
Could mean they're overvalued because software is much, much easier to scale. That's why it gets, a higher price to earnings ratio. Utilities, they're bogged down. There's a cap to them. There's regulation. They're necessary. They're essential. And so, they're valued at around 16, 17 times earning. Software tech companies are valued at about double that, right? So maybe you'll start to see them come down once they're sort of essential and very asset heavy.
Well, they are still growing fast. That's
Meantime, Dee's tweet about Claude and sort of developing her own Monday.com, for example, gets included in this morning's desk note over at Morgan Stanley. As you said, Dee, 2026 is wild.
It's wild. Full disclaimer, it's not a full Monday.com, but for my use, it was pretty remarkable. And so my point is just imagine someone who knows what they're doing in enterprise software. They could do a lot more than what I did yesterday in an hour while I was having my coffee.